the leap. Today, we're going to be talking about futures margin. So you know what? One of the great benefits of margin is capital efficiency. And, that seems like such an opaque word, but it's really, what can I do with a finite amount of capital? Very few of us are Tom Sossoff, where that never comes into play. Among the mortal world, we are all constrained by the amount of capital. So how we use that effectively is so important. So let's get into it.
This is a great, part of the beginning as well, because many people like myself, I don't even think about the idea of futures when I trade it at a firm, right? You just trade. I mean, you're trading with somebody else's money. My only real interaction with margin is when I've traded on my own. And I've traded some stock, with a margin account. But honestly, I really mostly, I'm more of an options trader than a stock trader. As we always talk about with options, we want to be options traders, not really stock traders. So with an options account, you don't trade on margin. So this is, while I've had some limited interaction with margin, this is going to be good.
Very good. Good deal. Here we go.
All righty. What we got here? What is futures margin? Futures margin is the difference between the total value of an investment or product and the amount borrowed from the broker to purchase said investment or product. What we got here? So we got the total asset value minus the loan amount equals the futures margin. What does that mean, Pete?
So total asset, or, notional value is the term we use. How much are we controlling? Such an important concept. And it's interesting you mentioned that. When you're trading for a firm, that you understand the product, you look at the amount of movement, and you gauge your positions basis that. You may trade 200 Eurodollar 90-day interest rate futures at a clip because it's $125 to trade it, and it moves 2 ticks a day. Trading mini S&Ps or crude oil, different equation, because that can move $3,000-$4,000 a day. So total asset value, or notional, is the amount we control. The amount we have to put up to control that. We talked about it yesterday, last week, the idea of a futures contract. And why do we get this leverage, or why do we get this amount? It's the nature of the futures contract. So the total asset value minus the amount that we have to use or that we forego out of our account is your futures margin. And it's as simple as that.
So, and I think we get into this with a specific example on our later slide, but, just for now, for people and for myself to understand, when we're talking total asset value, say we're talking about, whatever future, say you said Eurodollar. So is that the price where it's currently trading times that multiple? Is that what we're talking about here? Or, okay, minus the loan amount we get? That's
exactly right. And we talked, institutional futures, it's that challenge that everybody's got a different multiple. And what that multiple does is get you to that notional amount. How much am I controlling? And that's always an important dynamic. And I think, I'm so glad we're talking about it early, because it's probably the thing traders learn when they're having a bad experience. It's like, oh my God, I didn't realize I was controlling that much. It's funny. I was at a show one time and I talked to a guy and he goes, I won't trade gold futures. They move much faster than gold. And we know that price-wise, they move exactly the same. It's just how much you're controlling. So that is, again, that you're spot on. That price times that multiplier. And the good news is the multiplier never changes. So once we get that under our belt, the only thing that changes notional is price.
That's and that's good. We can definitely move that slide, but next slide. But I think it bears to mention here. You said something really poignant. The guy said he didn't know how much he was controlling. People always know how much you're controlling, right? We've seen that play out more recently in the market. So that's a good point.
Absolutely. And there's an elegance with stock, whether it's 1 share or 100 shares, or knowing that the option is based on 100 shares. Whatever you're trading in that world of equities, no matter which of those 3,000 or 4,000 names and the options on them, it's always 100 shares. And that's an elegant multiplier, where futures, and now small exchange futures are great because the multiplier is 100, no matter what you're trading. And that, we feel, takes away one of those great challenges to adoption is that, well, I know what the multiplier is. All I have to do is take the price, times it by 100, and that's my notional.
That's good. That's good to know. See, that's called foreshadowing. Okay. So
Jumping ahead.
yeah, right. Okay. So when buying a stock, most brokers require that you pay 50% of the investment value. In theory, they loan your account the other 50%. So we have total asset value is the 100%, as we talked about. That loan amount is 50% of that, and that gets us to the stock margin of 50%.
Right. So your leverage is 2 times. So that's pretty much the best you can do. So our Reg T or traditional margin account gives you margin 2 times of what you're controlling. Now, you can speak to this, and I'm curious your thoughts. The cost of that in terms of what you're trading, that borrowing is, I mean, how did you consider any cost for us to do business? The bid offer, the commissions. Here is another cost or a friction in terms of us before we turn a profit, what we have to bear. How did this ever figure out? Now, you were primarily an options trader, and you are primarily an options trader, but how did that friction ever figure in to the way you traded?
Well, that's a very good question. I mean, when going back to trading at a firm, that those frictional, I mean, there were so many frictional costs, actually.
Yes.
The cost of your seat, which is, again, when I came in from a completely different field, and I really didn't know about all those costs. And so, the idea of the cost of your seat, the cost of the research team that we had, the cost of Bloomberg. I mean, all of those, we're not even talking about trading yet, right? Then you get to the idea of trading. And yeah, it is important to try to get, really good fills where it's mid, or we did have an execution desk where we did a lot of, interaction with banks on the street where we would get a lot of flow from them, and you would try to get on those trades. However, a lot of times you had to be in the top 10% of the trading, which is decent of a trader I am. I wasn't that in our group. We had some really good traders who were able to get that. So those are the ways you do try to reduce those frictional costs, as you say, because those are important. And as you kind of, the next thing was trading on my own. When I am also a retail trader, and I have been. And so, for a while there, like we know commissions were a thing. That's a frictional cost. I mean, they used to have that a ticket, as we call it, the $9.99 on any trade that you had, or higher before that, honestly.
Right.
But, then that's been eradicated for the most part nowadays. But it's important. And now that I see what you're getting at, that idea of frictional cost is important, because you do have to think about those things on top of the profit you eventually want to make, given where you bought or sold something.
Yeah, absolutely. And it's, one of the things we like to talk about is, a large number of occurrences, be small trades that we smooth our P&L by having a large number of occurrences. And it's certainly not just to trade for trade's sake, but to be able to diversify with strategy, diversify with product. When you're using on each trade, you're using 50% of that notional value. By definition, you're limiting your amount to employ that, trade small, trade often methodology. And you're also, the whole idea of the loan amount. I like that, because that truly is a loan. It's a down payment on ownership, where futures are a different animal.
So that's also another reminder of, like you just said, as far as like to trade small, trade often, to not get too big in one position, essentially.
Right.
Okay, good. All right. Okay, so we are. Futures margin is more dynamic than that of stocks, which can lead to greater capital efficiency. And I think this is something that we use across the trading landscape. This idea of capital efficiency, right? Like, that's a big term. So what do we got going on here? Explain this one to me.
Well, and we talk about capital efficiency, return on capital, and all those, they seem like so opaque. What does that mean to my P&L at the end of the day? Because honestly, that's the first thing, I open my statement at 4:30 in the morning. That's the first thing I look at is, where's my P&L? And I don't think, I think most of the world lives by that. So return on capital is really okay, I'm using my capital as efficiently as possible. In other words, I'm having a diversified set of occurrences more so than I can because of the leverage of futures. So that improves the efficiency of trading a number of different things. And here it's just a simple, we're looking at SFX, a small US dollar index on the small exchange, combination of 7 different currencies, a really updated reflection on the dollar. There's several dollar indexes. They were constructed based off of what they call a trade weighted index that really was built in the 70s. So we've got renminbi, peso, Canada. There's a much more contemporary dollar index, which is great. So we're looking at notional value that we just talked about of 14,500 basis where the index is. Now we see that notional moves. And why does the notional move?
SFX right now, that's where it's trading. Like, or well, not right now, but like that's where it's trading, 14.5.
Right, 14.5. So, and what this has told us is the dollar's come off a little bit. So the dollar's fallen a little bit in the last year and a half. So what moves that notional? Not the multiplier, which we always know is 100, but the price. So the price is the only thing that moves the notional amount we control. Now, the great piece is we just looked at controlling 100 shares of a $20 stock. That's $2,000 in capital I have to put up to buy that stock, or I can borrow $1,000 and trade that stock. So there's 2,000 of notional in the equity world. Here we have 14,000 in notional exposure. And because it is a futures contract and not down payment on ownership like in the equities world, our margin is completely different. We use a different margin model. It's called SPAN. Just understand that it basically looks at movement and volatility over the last year, but most importantly, what's the number? $185. So we're controlling 14,500 for a margin requirement of $185. So instead of the $1,000 we'd use to control that $2,000 in stock, we're controlling $14,000 in product for $185 of margin. So that $185 gives us this exposure at a much more capitally efficient place, which enhances our return on capital. So those two opaque terms start to become much clearer, I think.
And so currently this is our position. We have one future of the SFX for it's worth, I mean, the value is 14.5, but we're using 185 for that. Now, is that of that 185, is that 50% margin, or is that the total of our like all in right now that we have for that position?
Well, great question. And so a futures contract, the margin is not a down payment on ownership like it is in the equity world. You're borrowing that $1,000 to basically fulfill your ownership of those 100 shares at $20. So the margin here is what they call a good faith deposit. It is the amount you put up at the clearinghouse to guarantee basically your performance on your contract, the position you have against everyone else. Now, this may be a bit opaque, but in the world of futures, you and I buy this SFX, you sell it. You and I never trade with one another. You're always trading in the marketplace, but the clearinghouse is guaranteeing that. So your performance or the ability to trade this product requires that $185 for the clearinghouse to feel comfortable about guaranteeing all those trades. Now, the question always becomes, does the $185 move? We know in the world of Reg T, it's always 50%. So if it's $20 stock, it's $1,000. If it's a $50 stock, it's $2,500. In the world of SPAN margin or futures margin, does that 185 move? It does. And what do you think moves that, Jermal?
I don't know.
Okay, fair enough. So it's important.
Interest rates?
What's that?
Interest rates?
Actually, you know what? Interest rates too, and volatility and movement of the product. Most importantly, volatility. And if you think about it, if a product's more volatile, it means it moves more. And that good faith deposit should be higher to guarantee the integrity of the trade. Now, the good news is it doesn't go from 185 to 360 to 720 in 2 days. Since the model that they use averages 252 days of movement, that margin will change incrementally. We just had a margin change in our 10-year note future, and it went from, I believe, $179 to $195. So you will see it ebb and flow with changes in volatility and with bigger price movement. But it is not something that will double or halve in the matter of a couple of days. So that's important. It's important to understand that, yes, it can go higher. So this is one of the reasons why we never like to commit $5,000 to a bunch of trading ideas with $5,000 in our account. Yeah. We want to be able to keep our ideas if margin does change a little bit. So
actually, I guess that makes sense. Yeah. See, I'm a little slow, Pete. I had to think for a second, but now that you mention it, I think back to February, when we saw the metals do what they did, particularly silver, and I'm sure SPRE probably margin might have changed in that time period because it was relatively volatile. So it makes sense.
Right. And you know what? They're over. And that was, I'm so glad you brought that up during the pandemic. That was a huge move. And there was a case over 6 weeks. You saw silver margin go from, I want to say, about $4,200 a contract to almost double. Now, but that was a period over 6 weeks. And the amount of movement, you could get a sense that if you see a product that starts to, the 30-day volatility goes from 25 to 50, and the movement on a daily basis doubles, chances are margin's going to be adjusted. So you know what? This is why we don't commit all of our capital to trade ideas. And we're willing to, honestly, those are the times often we want to trade most, when there's back and forth action, and we would expect to see a little bit of increase. But the good news is the increase, it doesn't happen in a day or two. And often when it does, it's relatively incremental. And you would think, well, volatility doubled in a day. Why doesn't margin double? Well, the exchange is mindful that they want to incrementally change that margin so people don't get the discomfort of all of a sudden, geez, now I don't have enough margin in my account to carry that idea forward.
Yeah, that makes sense. So the volatility is what makes it a little more expensive on the margin side, which is kind of relatable in options as well. When volatility goes up, the options get more expensive. We've seen that with like Tesla more recently, definitely with GME. So it makes sense. Okay.
Absolutely. And you know what? In the same way too, if we get a quiet period, vol comes in, you'll see that margin come in a little bit. So it's a very efficient way to do this. And the one thing I want to just talk a little bit about, so you see margin here is $185. And I mentioned for a big silver contract, I think it's around $8,000 now. And you'd think, why is that? Well, it's really, every exchange uses the same model. And it's just a function of three things: the notional size of the product, the amount of movement over the last year, and volatility on average over the last year. So when you look at a much smaller notional product, like the small exchange, that makes sense versus the 5,000 ounces of silver you're controlling at, let's just round it up to $30 because I can't do the math at 25, which is $150,000. So bigger the product, bigger the margin, bigger it can move. So no different. It's not like I get extra leverage with a big product or less leverage. It's all a function of the same three variables: notional size, volatility, and price movement.
See, this is fun, man, because we could be on this topic just right here for a while because, you know, it gets me to thinking, you know, and I think maybe we should table this and maybe go for next time, but just something to throw out there. When something is higher margin, is it more interesting to trade at that point in time because there's more opportunity, right?
Yeah. And I think you and I, as active traders, we're mindful of that higher margin level, sometimes I've heard, oh, well, that's the privilege of trading a more elastic market. It's not. It's just the number is the number. It's a formula. But you're right. Higher margin levels traditionally mean greater volatility, which as an options trader we want, and greater back and forth, which as a static delta scalping trader or directional trader is what we want also. So you're spot on. And that is an interesting discussion about, you know, that tradable opportunity at a different cost.
All right. So last slide we got here. Futures margin, the amount you must post to buy or sell an asset, which is usually less than the stock version.
Right.
So the left here, we got, stocks, ETFs are about 50 to 100%. In small futures, we got 1 to 50%. Oh,
right. So, and here is just, again, summing up that, I don't want to say static, but that consistent nature of the way equities work. The Reg T margin, that 50% is universal. Span margin or futures margin, a different animal. So a much more efficient animal, you're able to control much more notional. And we'll talk about that too in the future, because that isn't something you discount, because, the question becomes, I'm controlling 14,000 of notional for $185. Does that 14,000, even though it only cost me 185, does that fit into my portfolio? Is that, I don't want to say equivalent, but is that sized appropriately for my portfolio? Because, you look at like I said, a $300,000 $150,000 silver future. Now at $8,000, a lot of us say we had a $50,000 account, that fits. But does that $150,000 position in silver fit against everything else we're doing? Yeah. And that's where the mismatch of institutional futures often comes in. And that's where the elegance and simplicity of small futures really resonates.
Yeah, that's a key point, because I've even seen the same thing in like the ETF, for example. I mean, back in the day when we were trading at a firm and we'd have all these different equity positions. And there was a time, I think it might have been, I'm trying to remember the last time silver really made that move, must have been 2010, 2011. We had a pretty big silver position in the SLV ETF in the portfolio. And honestly, it really didn't match up. Now, it didn't hurt the portfolio, but it didn't really help either. Now we were just taking a shot on it at the time. But you bring up a really good point. Sometimes some things just don't necessarily fit in your portfolio. And this is a really cool and interesting, way to look at it as well.